Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I think there's actually a lot of value that people share, get different viewpoints and paradigms on the markets. The topics are going to be related to wealth building, financial topics, and commodities. I think commodities over the next decade or 5 to 10 years, huge opportunities there. It could even be longer than that, depending on the particular commodity itself and the supply demand imbalance. I was listening to Peter Lynch, a lot of his audiobooks the past couple of days. Go back through those. Very similar viewpoints to the viewpoints that I try to adopt. So very similar to him. I just play it more in the commodities sector because commodities can go up very quickly. They can make decades of returns in years. Decades of returns in years. That's why I get so excited. Unfortunately, though, you have to ride through a lot of volatility. And some of the questions that someone had asked me about the services that I provide on the website and the strategies that I deploy, I want to answer that. And I think it'll be worthwhile going through that anyway. And I'm going to do that first before we go through any information on the on Twitter. So let me go. I'm going to pull this up and answer some of the questions that this person has. The question is, do I have a model portfolio? I believe you do judging from your website, but of course I can't see it yet. I share the portfolio that I have. Now, your portfolio may not look exactly like my portfolio. I set up that portfolio in 2020. I originally bought a lot of precious metals companies in March of 2020, and I rotated very heavily into uranium and into oil in September, October of 2020. You can go back and look at my videos on YouTube, and you can verify some of the companies that I went into. I shared them quite openly, and they are massively up. So my portfolio, the way it's looking like today, is very skewed towards oil and gas, just because oil and gas, energy service, and uranium, because they've gone up so much. I didn't originally plan for my portfolio to be roughly 50% oil and gas. It just happened to be that way because of the returns that I got from the bottom of 2020. Some of those returns have been 10, 20, 30 times my money in specific positions, and I have that across multiple companies. And that really transformed my portfolio massively. The question that you should have is not the companies that necessarily got me there, is how did I know how to do it? What did I use? What were my strategies to go big when people were fearful, when people didn't want these companies? They told me I was wrong. They said that oil's never going to go back above like $30 or $40 a barrel. And I was sitting there saying, look, we're going over 200, 250 plus. Back in 2020, by the end of the bull market. And the way that I'm not doing this by making predictions, and I'll show you kind of how I'm doing it, but I did it because of the three pillars that basically I found to be valuable in the market. The three pillars is technical analysis, ratios, and market conditions. The market conditions is what causes the ratios to move. Technical analysis is a way to identify bottoming patterns, bottomings in ratios. It's a way to objectively look at the markets. So there's two things that you need to get right, two big things. There's other things too, but two big things that you need to get right as an investor. The first thing that you need to get right is you need to get the market conditions right for money to rotate into the thing that you want to invest in. The best time to do that is when there's an inflection point between one paradigm and another paradigm, and that doesn't happen often. It happens once every 18-ish years, and it's based off the real estate cycle. It can be a little bit longer, it can be a little bit shorter than that, There will be opportunities to buy within the big secular cycle as well as the waves kind of move up and down. That's Elliott wave analysis. But there are these opportunities that only occur very infrequently in markets. Warren Buffett uses that approach. You can tell he's sitting on a boatload of cash. You know what he's doing? I think he's waiting for a market crash where valuations get better, and then he deploys a whole bunch of capital. So he during the middle of some of these moves, he just accumulates cash until there's an opportunity to deploy it. And he's waiting for a time in the market where fear is very high and people sell off assets massively. So you can't be fearful when other people are fearful. You basically have to say, I'm going to do exactly what I'm trained to do with the strategies that I'm going to deploy. And that's what I do. I don't get afraid when other people get afraid. I get greedy when people are fearful. I try to. Sometimes it does impact me psychologically. I have to plow through it. I'm still a human, just like everyone else. So the market conditions, it was at an inflection point. The ratios were blown to the downside in oil and gas. We had ratios far above 30. 30 is basically a buy point when you look at history of a long-term history of gold to oil ratio. 30 is a pretty cheap ratio. We went into over 100. We went way up there. And then it came down to about 50 and stayed at 50. And then all of the charts were putting in these big bottoming patterns and moves. And that's the time to load up. That's where I made a boatload of money. And anyone can do it. You just have to train yourself to do it. You can see what I'm buying, what I'm doing on the website. I also track all my buys and sells. So you can see what I'm buying, and I usually do videos to communicate to members, like I am right here, on the individual companies, why I think they look good, and the setups technically. And I try to time my purchases as best I can. You're not going to nail every single bottom to the degree that I think people can get the bottom. But I try to get within as close as I can of a falling wedge, double bottom, inverted head and shoulders. Try buying the right shoulder or the head if you can, if you've got the cojones to do it. And that's what I try to do. It doesn't mean I'll be successful every single time. So that's what I try to do, and I've got the ratios, the valuations at my back. I'm a hybrid investor. I use technicals and fundamentals. I've been using fundamentals and really leaning on the ratios to get my entry points. The way that I'm evaluating the companies is I'm looking at basically the capacity, the infrastructure and capacity where cash flow can be generated from. And then I look to see where the commodity pricing is at. If we're at a very low commodity price and we've got a very large infrastructure of productive capacity to produce cash flow out in the future if the commodity price goes way up, if I'm bullish on that commodity, I think that's a really good risk-reward play. I also look at the fractal patterns, which is in technical analysis, to see how big the lead-in pattern is. Generally speaking, the bigger the lead-in pattern, the bigger the move after that pattern. Some of these lead-in patterns are massive in some of the companies. What does that mean? It means that as we get these inflationary impulses into the market, those impulses can be from stimulus, they can be from the real estate market, and they can be from deficit spending. They could even be from the reverse repo. There's so much going on in these markets right now. It can come from so many different avenues versus history. Historically, if you were to look at the thesis kind of the channel, the real estate cycle, the business cycle is really the only impulse credit expansion phase that it came from. Now we're getting it from all sorts of man-made things. It's a lot more difficult to predict, not really to predict, but it's a lot more difficult to kind of know where we're at in the cycle and what's driving the cycle. And we've got a slowdown in bank lending. So in the short term, we could get a slowdown, definitely. So that's kind of how I'm picking it. I'm looking at fractals, which is technical analysis. I'm looking at uh, the productive capacity that this company that possesses. I think that deals with the risk reward. I look at the ratios to make sure that we are buying things that are incredibly cheap. And then the market conditions are changing in favor of inflationary assets, but that doesn't mean you're going to get one big inflationary impulse move. You're going to get multiple impulse moves as interest rates are absorbed into the market and cause havoc and slowdowns in it as it kind of impulses upward. We have a major imbalance in the housing market. It is massively imbalanced in terms of single family homes in the residential sector, which caused a gigantic I'll call it an unaffordable stage right now. And interest rates are driven by inflation, and I think stimulus money caused interest rates to maybe go up a little bit too high. So I think the possibility of a slowdown is there, but I'm not trying to time the slowdowns, guys. I think we're in this big secular bull market of commodities, and the secular bull market is going to provide opportunities for a long-term hold. The valuations are all there. There's going to be slowdowns. There's going to be volatility in the short term. I'm a long-term investor looking for very outsized returns. And as long as the valuations are good for the investments that I'm in, I'm going to continue to accumulate. So I'm not a short-term trader. Here's some other questions. It says, I suppose you provide entry exit points for the suggested assets. Yes, they are of what I'm doing. So you get to see what I'm doing. Now, I don't just go over companies that I'm only buying. I go over a whole array of things in a bunch of different sectors. The sectors that I cover are uranium, oil and gas, exploration production, energy service, dry bulk shipping, diversified mining companies, and the companies that are specific. So that could be copper. Sometimes I go over tin, not as often, but it's mainly copper, iron ore, steel, aluminum, all those types of companies there. I go over precious metals companies: gold, silver, platinum, palladium, the whole mix there. I think that what's coming is going to be a big bull market in energy, and I think that's going to translate into currency problems. And that is why I think precious metals are going to do something ridiculous, much like the 1970s. So those are the sectors that I cover. It says, do you use a stop loss? Use risk management strategies, leverage. I use no leverage. I think leverage is a way to um, get hurt with volatility. So I don't use leverage because the volatility is so large in commodities. I do not use stop losses. I buy companies. That's why I'm a hybrid investor. I buy companies that I think have generating capacity out in the future with massive generating capacity. The way that I reduce some of that volatility is I cost average into positions. So when I cost average into position, it basically reduces some of the risk of the entry point. I'm not a short-term trader. Not a short-term. I do not like short-term trading. I don't even look and follow people who do short-term trading. I used to short-term trade way back in the day. It's not worth it. I don't like it. Some people say, oh, you're just not good enough technical analysis wise. I think I'm better than the majority of people that I follow. I'm as good or better. And I think my entry points smoke them. My returns have been massive since I've implemented the 3-pillar strategy. I've had a few years that I was up 6 times my money of the entire portfolio. Granted, that was back in 2020, 2021. That 2021 was a big year. And if you took a year time frame. So doing very, very well with the strategies that I'm deploying. I see absolutely zero reasons to trade. I do not do options. I think options are the quickest way for retail investors to lose all their money. I think that is incredibly a bad strategy to even touch them for the majority of people. And what makes it so difficult to make money in options outside of doing covered calls that you're selling? If you're buying options, you're basically putting a time frame on it, and you're putting a price on it, and you've got volatility on it. That is incredibly hard to play very accurately on a short-term trade for a retail investor. I don't think it's worth it. I really don't think it's worth it for retail investors. Um, do you suggest weightings for the different instruments? I can't remember. I can't do anything particular to any individual person. What I do is I share exactly what I'm doing. I just say, you know what, I'm overweighting this position. You can see that I'm overweight certain positions in my portfolio. And that is what you can tell is I'll say I'm going to put a lot of money in this. This one will be a lower weighting. It's got too much risk for me to weight it with a good weighting. And another thing is your portfolio may not look like my portfolio based off of when I bought it. I buy whatever's cheap. A lot of people say, what are the weightings that I should weight a portfolio? What are my weightings? My weightings are not what should be a portfolio that is set up today because I'm way overweight oil and gas, which I'm very much bullish on. But I'm also buying things right now that are not oil and gas. I'm buying dry bulk shipping. I'm buying steel and iron ore. I'm buying um, precious metals companies. I'm diversifying into those because they're cheap. And that's how I'm doing it. You're going to know what I'm buying. Every once in a while, if something comes up and it looks like a bottom, I'll buy some energy service companies or an exploration production company and add into those positions. I try to buy big dividend paying companies. Dividend payers pay you to wait. Plus, I think there's a lot of upside in them. If they've got good chart patterns and the sector is breaking out and looks good, I'm going in. I'm going in, guys. I know the recession people are here. They're loud and strong. I get it, but I don't think you could predict a recession with any sort of great accuracy. I also think that a recession is just a blip in this big secular bull market. So it'll be a blip lower that gives you a great buying opportunity. And if you want to save cash for this potential buying opportunity, do it. That's where my thoughts are at. You don't have to be 100% deployed. Keep 10, 20, 30% cash. It's fine. And when the time comes, deploy it with everything you got. When the fear is in the market and people are telling you that oil can never go above $70 again, then that's when you want to load up on it. Here's some more questions real quick. Is there a minimum investment amount size you would suggest? No, it's dependent on the person. The strategies are the same depending on the size of the portfolio you're running. You just take bigger positions when you have more money, and you take less positions when you have less money. As long as you don't have transaction costs, you'll be fine. You can use anything. What time frames do you expect the trades investments to work? Months to year, shorter, longer? I'm a longer term investor. I expect these to. I hope using technical analysis that we can have them work in the short term for everyone. But sometimes I'm buying companies that I don't expect to go up for a year or two. And I'm buying them at really cheap prices. Some of the entry points are like that. Other entry points are very good and they return very quickly. And it depends on the entry point. And don't worry, I'll let you know. Like I will let you know what I think is going to occur. There's companies that I'm buying at the tips of falling wedges that may have a false breakdown, and I cost average in this entire bottom. And I'm hoping I can get 10, 20 times my money in less than a decade on that particular investment. Now, I'm not loading all my money into it. I'm spreading it across these 5, 6, 7 different sectors that I think are the cheapest in the world. And then I wait. I'm patient, very, very patient. There's a couple of things that are required if you take this approach and strategy. You need to, one, be incredibly patient. You have to be patient. Two, you have to have conviction of what you're buying. You need to know a little bit about the companies that you're buying. You have to know that why you're buying this company is because it is cheap as all get out, and the infrastructure is in place to generate cash flows that are ridiculous in the future. If you can stomach volatility, you can have conviction, and you know that the setup is forming, in terms of the technicals are forming, you can try to buy bottoms. Now, that doesn't mean I put all my money in one shot. I might try to put up to 25, 30, 40% of my position as I try to catch the bottom, and then I buy the rest of it as it breaks out of patterns to the upside. Then I pump it again. The strategies are there. I talk to people, and what is valuable about this? There's a couple things that are valuable about joining the website and what you get from it from me. What's valuable is you get to see my approach and the strategies that I use and how I deploy them over a period of time. Then you get to see the returns that are generated. Once you tie in how I'm doing it and the returns, then you'll know how to pick the stocks and individual companies yourself. I'm not going to try. If you're a short-term trader, I would not sign up. If you're a longer-term trader and you want to be an investor and you want to invest this for the next decade, I would definitely sign up. That's the way that I view it. What you're going to do is you need to tie what a good entry point looks like. What does a chart pattern look like that is good for a bottoming pattern? What works and what doesn't work? And most of the people, if you look on the website, they're migrating to a certain strategy. They've changed their entire strategy since they've begun because they've seen success in the stuff that I've brought in front of them. And I talk about risk. This is a high risk company. It can't generate cash flow. These are the cash cows. This is what I would overweight in my portfolio and how I would position in it. And this is what I'm doing. And then you get to see me put on the positions. I don't know everything. I'm not going to be someone who's going to lie to you. I will be 100% truthful to you 100% of the time. I want you to be successful. I'm doing this because, one, I like doing this stuff. I love it. I love investing. I love talking about investing. I love interacting with people about investing. I love teaching about this stuff. So that's why I created the website. People wanted it. I created the YouTube channel because I am obsessed with finance. I'm obsessed with making money outside of a 9-to-5 job. I love investing because there's no cap to it. There's no cap. So whatever I can put into this and whatever I can learn and refine, there's no ceiling. There is no ceiling. I love that. This has nothing to do with politics, has nothing to do with garbage. The effort, the patience, the discipline that I have can be put towards the markets, and I can make hundreds of millions of dollars. That is motivation enough for me because I've got that upside potential. Now, I'm not driven by money 100%, but I can tell you it definitely helps the motivation. It definitely helps the motivation. So that's what I have to offer. I provide a midweek update. We do question and answer sessions on the weekend so you can interact directly with me. I post other stuff on the website as well in terms of educational stuff. I've got training videos, technical analysis training videos. It's tough to do fundamental analysis, even though we do cover it in some of the question and answer sessions, because what you're evaluating isn't the fundamental analysis of the cash flows today. You're projecting where the cash flows are going to be when the commodity price goes up. So you have to be very good at technical analysis and trying to get a commodity that's bottoming out and ready to come on higher. You can also use inventory levels and cost curves to help you out. And I have some of that stuff all on the website. There's a lot of information on the website. So I'm going to end it there. This is pretty long. I'll do a separate clip on the Twitter stuff. But that's what the website has to offer. We have a special going on. It's Turkey. It's in the description link below of what the website has. Now, if you guys want, I can try to reach out. You can sign up to try it. It's 50% off on the monthly, and you can go on Discord and you can ask people if they like it or dislike it, the service, and then you can try it out for a month it's $25 for that month. If you dislike it, No hard feelings. If you like it and you want to continue to go, cool. You're going to learn a lot. And you can quit at any time. You can quit at any time. So that's what I've got, guys. And again, if you want to sign up for a yearly membership, and let's say something happens where you miss a window where you get a discount, just reach out to me. Reach out to me. I'll work with anyone. And if you've been with me for a while, I'll hook you up, guys. Don't worry. Don't worry. Everyone is valued. That's a part of the community. All right, guys, that's all I've got for today. We'll catch you later. This is Finding Value.